If you observe carefully what's happening in the housing market right now, you'll notice something that doesn't make economic sense. Home prices are rising at 6 to 8% annually, while real wages are declining. Mortgage rates have doubled from 3% to 7%, yet prices haven't corrected. Affordability is at its worst level in 40 years, yet bidding wars continue in many markets. This isn't normal demand and supply dynamics. This is something fundamentally different, and understanding what's actually happening will determine whether you protect your wealth or lose it over the next 3 years. What I'm about to explain to you isn't a prediction. It's a logical consequence of monetary policy decisions made over the past 15 years that are now producing inevitable outcomes. When you understand the mechanics of how currency debasement manifests in asset prices, you understand why housing is behaving this way. And more importantly, you understand what happens next. The stakes are enormous. For a family with $200,000 saved for a down payment, the decision about whether to buy into this market at these prices could mean the difference between building generational wealth and losing a decade of savings. For homeowners with $800,000 in equity wondering if they should sell, understanding this pattern determines whether they capture value or watch it evaporate. This isn't about making predictions, it's about understanding forces that are already in motion. I've spent more than 40 years studying how debt cycles, monetary policy, and asset prices interact across different economies and time periods. I've managed capital through the Japanese real estate bubble of the 1980s, the US housing crisis of 2008, and the everything bubble we experienced during the pandemic response. When you understand incentives, you understand behavior. And right now, the incentives driving housing prices have nothing to do with genuine demand and everything to do with system-level distortions that cannot be sustained. Let me give you 3 specific data points. First, the median home price in the United States is now $430,000, while the median household income is $75,000. That's a price-to-income ratio of 5.7 to 1. The historical average is 3.6 to 1. We're 58% above the long-term norm. Second, monthly mortgage payments on a median-priced home now consume 42% of median income at current rates. The historical average is 25%. Third, the Federal Reserve's balance sheet, which holds mortgage-backed securities, remains above $2.5 trillion despite all discussions of tightening. These 3 facts tell you that housing prices are not being driven by organic demand, but by monetary conditions that created artificial affordability and excess liquidity. The fundamental mechanism you need to understand works like this. When central banks expand the money supply dramatically, that new money doesn't flow evenly into the economy. It flows first into assets, stocks, bonds, and real estate, because that's where the financial system channels it. People with access to cheap credit bid up asset prices. Those asset price increases then create a wealth effect that pulls in more buyers who fear being priced out forever. This creates a self-reinforcing cycle that looks like genuine demand, but is actually monetary inflation manifesting in asset prices. Think of it like a dam holding back water. For years, the Federal Reserve kept interest rates at zero and printed trillions of dollars. That money pooled behind the dam of asset prices, pushing them higher and higher. When they finally started raising rates in 2022, everyone expected the dam to break and prices to crash. But here's what's actually happening. The dam has cracks, water is leaking through, but the structure hasn't failed catastrophically. Why? Because there's still so much money in the system, because institutional buyers are absorbing inventory, and because people who locked in 3% mortgages in 2020-2021 refuse to sell and lose that rate. This creates an artificial supply shortage that keeps prices elevated even as genuine affordability collapses. Right now, we're experiencing several simultaneous pressures. Housing inventory is at historic lows because 90% of homeowners have mortgages below 5% and won't sell to take on 7% rates. Institutional investors, private equity firms, pension funds, sovereign wealth funds are buying single-family homes as inflation hedges, treating them as stores of value rather than shelter. Foreign buyers, particularly from countries with less stable currencies, are parking capital in U.S. real estate. And younger buyers, afraid of permanent price out, are stretching finances to barely qualify with minimal down payments and maximum debt-to-income ratios. History is an excellent teacher if you're willing to examine previous housing bubbles and understand what actually drives prices and what causes them to adjust. The Japanese real estate bubble from 1985 to 1991 provides the clearest parallel. Prices in Tokyo increased 300% in 6 years. When the Bank of Japan tightened policy in 1990, prices began a 20-year decline, falling 70% from peak. Someone who bought in 1989 was still underwater 20 years later. That's not a correction. That's generational wealth destruction. The U.S. housing bubble from 2004 to 2008 shows a similar pattern. Low rates and loose lending created artificial demand. Prices in Phoenix, Las Vegas, and Miami doubled in 4 years. When the Fed raised rates, prices fell 30 to 50% in bubble markets. But the wealth didn't disappear, it transferred. People who sold in 2006-2007 preserved capital. People who bought in 2009-2012 built generational wealth. What makes now different is we have both dynamics. The Japanese lock-in effect from ultra-low rates and the 2008 price-income decoupling, plus institutional ownership creating artificial floors. To understand where this goes and what it means for your decisions, you need to understand 3 fundamental principles. The first principle is the difference between nominal and real prices. Nominal prices are what you see on Zillow. Real prices adjust for inflation. During the 1970s, home prices increased nominally, but declined in real terms because inflation outpaced appreciation. A $50,000 house in 1970 selling for $120,000 in 1980 increased 140% nominally, but only 25% in real purchasing power. Right now, we're entering a similar period where nominal prices may remain elevated while real prices decline significantly. The second principle is understanding total cost versus monthly payment. Most buyers focus on monthly affordability. This is wrong. At 3% interest, a $400,000 mortgage costs $1,686 monthly and $206,000 in total interest. At 7%, that same mortgage costs $2,661 monthly and $558,000 in total interest, 2.7 times more. You're paying an additional $352,000 in interest alone. Even if prices decline 15%, you're paying more in total cost. The third principle is forced versus discretionary sellers. Discretionary sellers with low rates and equity won't sell. They'll wait years. Forced sellers facing job loss, divorce, or financial stress must sell regardless of price. As long as unemployment stays low, forced selling remains limited. But when economic conditions weaken, forced selling surges and prices adjust rapidly in a one-way market lower. Let me tell you a story about 2 couples I observed during the last housing cycle. This isn't made up. It's the typical pattern. In 2005, the Anderson family decided to buy their first home. They were 32 years old with $40,000 saved for a down payment. They looked at a house in a Phoenix suburb listed at $350,000. Their real estate agent told them prices were going up 15% per year, and if they didn't buy now, they'd be priced out forever. The bank offered them an interest-only mortgage at 5% that kept payments low initially. They could barely afford it, but they feared missing the opportunity. They bought the house with just 10% down, taking on a $315,000 mortgage. Their monthly payment was $1,312 for interest only, plus taxes and insurance brought it to $2,100 total. It stretched their budget, but everyone around them was doing the same thing. The Chen family, same age, same savings, looked at similar houses in the same market. They ran the numbers and realized that at $350,000, the house cost 6.5 times their annual household income of $54,000. They looked at historical ratios and saw this was far above the normal 3.5 to 1 ratio. They understood that interest-only mortgages meant building no equity while taking on maximum risk. They made a difficult decision. They'd rent for a few more years, save aggressively, and wait for better opportunities. Their friends and family thought they were making a mistake, watching prices rise while sitting on the sidelines. The social pressure was intense. At family gatherings, people asked when they'd finally buy, but they held firm to their analysis. By 2010, 5 years later, here's what happened. The Anderson family's house, purchased for $350,000, was now worth $210,000. They owed $315,000 on the interest-only mortgage because they'd built zero equity. Every payment went to interest. They were $105,000 underwater. When the husband lost his job during the recession, they couldn't afford the $2,100 monthly payment. They couldn't sell because they were deeply underwater and didn't have $105,000 in cash to bring to closing. They ultimately lost the house to foreclosure. Their $40,000 down payment was gone. Their credit was destroyed for 7 years. They lost 5 years of additional savings, approximately $30,000, that went into maintaining the property. Total wealth destruction, approximately $90,000 in cash plus 7 years of damaged credit, plus the emotional trauma of foreclosure. The Chen family continued renting for $1,400 per month, $700 less than the Andersons were paying, while saving an additional $1,500 monthly. By 2009, they had $130,000 saved. In early 2010, they bought a similar house in the same neighborhood for $195,000. They put $50,000 down on a traditional 30-year fixed mortgage at 5%, financing $145,000. Their monthly payment was $778, plus taxes and insurance, about $1,500 total. By 2015, their house was worth $280,000, and they'd paid the mortgage down to $130,000. They had $150,000 in equity plus $80,000 in savings. Total wealth, $230,000. The difference was approximately $320,000 over those 10 years from these decisions. The Andersons lost roughly $90,000. The Chens built $230,000 in wealth. Same starting point, same market, different understanding of monetary cycles. Now let's translate this to what really matters, how this affects you personally and what decisions you face right now. If you're a potential buyer with $150,000 saved, looking at $600,000 houses, you face a critical decision. That requires a $450,000 mortgage at 7%, monthly payment of $4,200 total, including taxes and insurance. You need $140,000 household income to qualify comfortably. Here's the plausible scenario. The Fed maintains higher rates to combat inflation. Growth slows. Unemployment rises from 4% to 6 to 7%. Inventory increases as forced sellers liquidate. Institutional and foreign buyers step back. Prices adjust 15 to 25% in bubble markets. Your $600,000 house becomes $480,000 by 2027. You bought with $150,000 down, so you have $130,000 equity now. At $480,000, your equity drops to $30,000. You've lost $120,000 in equity plus paid $50,000 in interest, $170,000 worse off than waiting. Alternatively, prices stay nominally stable at $620,000, but inflation runs 6% annually. That's 19% cumulative. Your house worth $620,000 nominally equals only $519,000 in today's purchasing power. You gained $20,000 nominally, but lost $81,000 in real terms while paying $50,000 interest. If you're a current homeowner with $600,000 in equity, wondering whether to sell now or hold, you face a different calculation. If you sell now, you capture that equity, but must either rent or buy something else at equally inflated prices. If you have a 3% mortgage, you're locked into an artificially low carrying cost that you can never replicate. The rational decision depends on your specific situation, time horizon, and whether that equity is needed for other purposes. Based on these principles and historical patterns, here are practical guidelines for different situations. For potential first-time buyers with saved capital, do not rush based on fear of being priced out. Keep 30% in cash for deployment when opportunities arise. Put 40% in treasury bills earning 4 to 5%. Allocate 20% to stock index funds. Keep 10% in precious metals. When prices adjust 15 to 20% or rates decline to 5%, deploy aggressively. For recent buyers, 2021, 2022, with low rates, you're locked in. Don't try timing a sale and rebuy. Your 3% mortgage is worth hundreds of thousands over its lifetime. Make extra principal payments. Plan to hold 10 plus years. For homeowners with equity and high rates, consider whether equity could be better deployed. A $500,000 house with $400,000 equity might be better sold, capturing equity to invest in diversified income-producing assets while renting for less than the opportunity cost. For homeowners with equity and low rates, hold. Your low rate is valuable. Your equity is real. Unless you need liquidity for opportunities or life changes, there's no reason to disrupt this position. What to actively avoid? Buying with minimal down payment and maximum debt ratios in this environment. Taking on adjustable rate mortgages or interest-only products. Using home equity lines of credit at variable rates to fund consumption. Buying investment properties with negative cash flow based on appreciation assumptions. Treating your primary residence as an investment rather than shelter. Believing that they're not making more land is a sufficient analysis of whether current prices are sustainable. Common mistakes to avoid. Confusing nominal price stability with real value preservation. Focusing only on whether you can afford the monthly payment rather than total cost and opportunity cost. Believing this time is different and prices can't adjust. Trusting real estate agents who make commissions only when you buy. Following the crowd into competitive markets without understanding the underlying monetary dynamics. Nothing in this constitutes specific financial advice for your individual circumstances. Real estate decisions depend on personal factors, job security, family needs, location requirements, risk tolerance, alternative options. These are principles based on historical patterns and current monetary conditions, not predictions about specific markets or timing. Here's what you need to understand at the fundamental level. Housing prices are not being driven by genuine demand based on income growth and demographic trends. They're being driven by monetary conditions. 15 years of ultra-low interest rates, quantitative easing, and money supply expansion that created artificial affordability and channeled excess liquidity into assets. When you understand incentives, you understand behavior. People are buying not because homes are affordable, but because they fear permanent price out. Institutions are buying not because yields are attractive, but because they're seeking inflation hedges. Foreign buyers are purchasing not because of quality of life, but because they're fleeing less stable currencies. These are not sustainable drivers of genuine demand. They're symptoms of a monetary system under stress. The housing market sits at the intersection of powerful forces. You have the legacy of unprecedented monetary expansion creating artificial scarcity through rate lock-in effects. Homeowners with 3% mortgages won't sell in a 7% environment. This reduces inventory and creates the appearance of sustained demand. But you also have affordability at 40-year lows, real wage decline, and younger generations facing impossible entry conditions. These forces cannot coexist indefinitely. The choice you face is whether to buy into the peak of this distortion or wait for the adjustment that always comes when prices decouple from fundamental affordability. History is clear. Asset prices that rise faster than incomes eventually mean revert through nominal price declines, real price erosion through inflation, or time. All three transfer wealth from late buyers to patient capital. You can observe what sophisticated capital is doing. Insurance companies are reducing real estate holdings. Some hedge funds that bought rentals in 2010-2013 are quietly liquidating at these prices. Ultra-wealthy families are selling second homes to capture equity. The pattern suggests they believe current prices represent opportunity to sell, not buy. When everyone from your barber to your dentist talks about appreciation, when people treat homes as investments rather than shelter, when speculation replaces analysis, that's when risk is highest. What makes housing particularly vulnerable is leverage. Most buy with 80 to 90% debt. A 20% down payment means 5-to-1 leverage. A 15% price decline means you've lost 75% of your equity. This asymmetry is why housing crashes destroy household wealth dramatically and why late-cycle buyers suffer disproportionately. The psychological component cannot be ignored. Fear of missing out, social proof, status seeking. These emotions cloud rational analysis. But these conditions mark late-cycle tops, not sustainable trends. The best opportunities come when everyone thinks you're making a mistake. The choice is yours. But remember, every housing bubble in history resolved the same way. Prices that rose based on monetary expansion eventually adjusted when monetary conditions changed, or buyers exhausted their capacity for debt. Sometimes through nominal declines like 2008, sometimes through nominal stability while inflation eroded real values like the 1970s, sometimes through decades of stagnation like Japan, 1991 to 2012. But the adjustment always came. The pattern repeated in the U.S. during the 1920s, 1980s, 2000s. It repeated in Japan, Spain, Ireland, Australia. It repeats because the mathematics of debt, income, and asset prices are universal. That's why this channel exists. Not to predict exact timing or magnitude, that's impossible, but to help you understand forces at work, recognize patterns from history, and position yourself to protect wealth rather than destroy it by buying into late cycle distortions. If this framework helps you understand what's really driving housing prices, if the historical parallels make sense, if you recognize the current boom is monetary distortion rather than genuine demand, consider subscribing. We'll continue analyzing these patterns and helping you navigate monetary transitions with clarity rather than fear. The great wealth transfers in housing always follow the same pattern. Those who understand monetary cycles, who distinguish between nominal price movements and real purchasing power, who buy when prices reflect fundamental affordability, these people build generational wealth. Those who buy based on fear of missing out at the peak, who confuse leverage with wealth creation, who believe prices only go up, these people transfer their savings to those who understood the cycle. You now understand the difference between real demand and system breakdown. You understand why this housing boom is different from genuine economic health. You understand the forces creating artificial scarcity and the mathematical impossibility of current price-to-income ratios being sustained. You have the framework to make informed decisions rather than emotional ones. The only question is, what will you do with this knowledge before the inevitable adjustment occurs?